Hello, everyone, and welcome to Innovator Insights from Idea to Impact, where we interview successful entrepreneurs in the e-commerce and product space. And today we're super excited to have Blake Hutchison with us. He is the CEO of Flippa. That's the #1 platform for people that want to buy and sell businesses online. So super excited to hear about that, but we also want to hear about Blake's entrepreneurial journey prior to Flippa. So without further ado, Blake, welcome. Thanks for being here.
Yeah, thank you so much. It's great to be here with you.
Yeah, exciting. So as I said, I think that a lot of our listeners can't wait to hear about what's going on in the world of M&A for online businesses. There was this crazy boom during the pandemic. I'm sure you were right in the middle of it. I remember going to Prosper and they were giving away Teslas if you were referring businesses. And the aggregators raised billions, and it was a big feast. And then it changed a little bit. So would love to hear your story. But before we go with that, would love to get to know you a little bit. Can you tell us where you're from, where do you grow up, where do you live, and family, kids, dogs, stuff like that. What do you do when you're not working?
Yeah, absolutely. I guess first and foremost, have lived and worked around the world. Spent some time in Tokyo, spent some time in San Francisco, New York. I'm currently speaking to you from my home in Melbourne, Australia, and you can hear a very thick Australian accent, so I'll do my best to enunciate as well as the Americans do. I've worked across a couple of different e-commerce businesses. First and foremost, I was a founder myself. We built an online media entity. We then pivoted to become a flash sales business for high-end retail. We then ultimately ended up having an e-commerce marketplace for specialty retailers. And that was an interesting experience because it was 2010. Uber hadn't yet arrived here in Australia. Logistics was a tricky thing, and e-commerce is nothing without a good supply chain, which I'm sure that you and your listeners can empathize with. The supply chain's obviously improved out of sight since that time, albeit, you can still have stresses within that. I then went and I worked for Xero, which is cloud accounting software, and I encourage every single e-commerce business owner out there to use some form of cloud accounting. Great experience understanding the value of that for small business owners.
Yeah.
I ran Luxury Escapes, which was an online travel retailer, flash sales for luxury hotels. That's now doing $1 billion. I took that from about 50 to 300. It's now doing substantially greater than that. And here I am at Flippa. So I live in Melbourne. I've got a wife. I've got a daughter. I play a little bit of golf. I'm not very good, but I love it. It's a great mental health release, or mental health program, I should say. I spent a lot of my time working. I must admit, I don't quite have the work-life balance thing figured out, but that's probably something that we all need to work on.
Yeah. I have so much golf merch, and I wear it all the time. I had a guy at work ask me, "Say, you big golfer?" And I was like, "No, not really. I just get a lot of free shirts."
Yes, well, I must admit my golf attire is probably not quite as good as members of fancy clubs might like it to be.
Yeah. So you're in Melbourne, but I assume Flippa is doing a lot of business in the US.
Yeah,
What's
so
the
we
division?
are an Australian founded company.
Mm-hmm.
The board is based here. I am based here. We have our engineering and product team based here. But yeah, to answer your question very directly, most of our trade is North American.
Right. All right. I can't wait to talk more about it, but I'd love to hear a little more about your journey first. So you're a founder, but you're not the founder of Flippa, right? So you started businesses, but you didn't start Flippa. Is that correct?
Yeah, that's right. A couple of quick stories in that regard. Having moved as a young Australian to San Francisco, I certainly got a sense for the entrepreneurial bug. I ultimately decided to copycat a US business and move back to Australia. It's funny because newsletters are kind of on the rise again, but back in 2010, there had been this flurry of really successful newsletters. Daily Candy, thrill list, urban daddy, seeking alpha in the finance sector, which is still around and flourishing today. And, people were making a good living out of creating media businesses built on top of a daily newsletter platform. And so I went home being Australia, and essentially created a lifestyle newsletter intending to build a big audience. Boy, oh boy, that's hard going, particularly in 2010 when it wasn't as easy as just signing up to Substack and Beehive and getting that newsletter going. So we had writers all over Australia, essentially covering the latest bars, restaurants, things to do, and trying to drive that always on immediacy with our content, knowing full well that we wanted to evolve into a commerce engine once we had a big enough audience. So, the entrepreneurial journey's hard. I was consulting a couple of days a week to an online travel business. That's the industry and the ecosystem that I knew so well from being in the US. So I sort of kept the lights on and a roof over my head. Moved my then girlfriend, now wife, moved from the US. She's American, Mexican American. That's a tricky play as well, isn't it? When you ask someone to move to the other side of the world and you're no longer earning a salary.
Yeah.
So, long story short, so many different concepts I tried out, having had a big enough audience to sort of MVP this stuff, get a proof of concept out the door. One of the funniest ones, I must admit, albeit I thought it was a pretty good concept at the time, was a box of good quality produce delivered to your door every month. So it was subscription commerce, and you pay $19.95, and we would ship you a box of samples of outstanding produce. Now, of course, there's lots of problems with that. Often within the box, there's perishables. Australia is a hot place, so if it's the middle of summer and you've got some chocolate samples in the box, it's a really tricky program. And then, of course, the logistics framework here in Australia was pretty poor back then. Still is actually pretty poor, but this is before Uber, and certainly before Uber Eats. And so, I found myself as an entrepreneur thinking that I was building a digital first business, driving my car around the streets of Melbourne, delivering these boxes every month. It was pretty ridiculous, really. So everyone was happy. The producers were happy, the customers were happy, and I was really unhappy. Low margin, but really, really happy customer base. So from that point, I thought I had something. I was very tired. This is now probably 3 years into the business journey. And so I thought, well, hang on, if the customers like it so much and the producers like it so much, why not create like an Etsy-like shopfront marketplace for these specialty producers to actually trade direct? So then again, this is 2013. The ecosystems, weirdly, time has moved very quickly in this space, as you know full well, and so do your customers. 2013, it was actually pretty difficult to build a subscription commerce engine, particularly on top of a marketplace. So we had to build from scratch a marketplace environment that would enable these chocolate makers, honey makers, wine producers, and everything in between to set up shop fronts in our digital ecosystem. Again, a bit like Etsy.
Yeah.
So they'd create the shop front, they'd merchandise their goods, we'd market it to our big audience that had historically been subscribers to this daily newsletter.
Yeah.
I would start to generate revenue. And again, it went fine. We got it to a couple of $1 million in turnover, but that's not a great business. As in, it wasn't great for the ambitions I had for it. Yeah. As I now know, running Flippa, that's a good quality small business. And we respect and empathize with all of the owners and entrepreneurs who create businesses of that quality. But the reality is we'd raised a little bit of venture. It wasn't scaling fast enough. The margins were low. Again, you had butchers, chocolate makers, honey makers, cheese makers, and the products were perishable, and you needed almost a real-time delivery partner. And so ultimately, wasn't really solving a problem that needed to be solved. And for the people who loved it, I wasn't delivering a good enough service. So that business sort
Yeah.
of ultimately, I believe it or not, I exited that on Flippa. So that began the beginning of my
Oh, really?
Flippa.
So your
I've,
introduction to Flippa was as a customer selling your business.
I certainly know the
Right.
torment of being an entrepreneur, and empathize every day with the entrepreneurial journey. So
Yeah.
hopefully it gives you a little bit more context. Um, I've always worked for founders. I love founders, the speed at which they work, the intensity and the passion at which they go about their day-to-day work, their vision and just ambition to create something bigger for the world. I love product makers and creatives. So it's kind of cool to now spend a lot of my day speaking to business owners and investors who, again, surround themselves by this world.
Yeah. And it must be exciting. I mean, Gamba is more on the front end of the creation experience, and you're sort of at the where we cover the two bookends. And I find it incredibly rewarding to work with folks and help turn their ideas into real products and real businesses. But it must also be gratifying to help them have that exit that most people are I think aiming for at some point in time.
Yeah, I did a session a couple of days ago, and it is really important that people do think with an exit in mind, because ultimately, you and I both know that running businesses is hard, and
Yeah.
ultimately, regardless of whether the business is doing outstandingly well or less well, there ultimately does come a time where you think about returning value for yourself, and probably for others within a business. So yeah, we encourage people to plan sort of 12 to 24 months out for an exit, get that sort of North Star written up and head toward that, and then find a happy pathway.
Yeah. If we were to back up even earlier, right? I mean, just like you talked about some of the considerations, some of the things that made your business difficult. What are some recommendations you could make to folks that are just starting out in their journey? They may still be trying to figure out which product to make and sell, and uh, anything you think that they should think about it at the outset, because like you said, 2 years from an exit, yeah, that's a great time to start planning. When you started, maybe even greater time to start planning for that.
Yeah. So I think probably the first piece is that you and I have both seen projections. You and I have both built business models and budgets, forecasts and projections for investors and for ourselves. And you very rarely get it right. And so when you go and approach, say, Jemba, and you're looking to create a product and go to market, I tend to ask people to be a bit more conservative than the estimates that they've put on paper, because you tend to get a bit upset. I did the same thing. I said we'd be $0 to $1 million year one, $1 to $3 million year two,
Yeah.
$3 to $10 million year three, whatever. And it's harder than that. And so until you've actually found your first 100 customers and got a sense for how long it took you to find them, the cost to acquire them, the unit economics for every individual customer, it's really difficult to get those projections right. And so rather than sort of sell yourself into a falsehood, think about first and foremost just landing those first few customers and sort of get a feel for how long it will take and the methodology that you need to undertake to get there. Probably the second thing is it is really important that people go where the world is today. So it's all good and well to be open AI or Perplexity and create this future-looking, future-forward product. The reality is most of us don't do that. And so you really want to be creating a product that you think has a necessity and need today, because very few of us raise enough money to go the journey. And so you need to thinking about the immediate term results more than anything. And that's certainly the case for e-commerce business owners. You really want to actually go where there's established competition, and it's something that most people don't think a lot about. They try to create something truly differentiated. Well, actually, if you can differentiate your sales pitch, your marketing positioning, your branding, the approach you take to win a customer, that's a better play, at least initially, than trying to create something truly unique. Because selling something truly unique to someone is about creating a new market, and creating a new market is difficult.
Yeah, takes a lot of capital. I mean, just like you said, if people are going to sell on Amazon, if people aren't searching for the type of product that you're selling, you're not going to get a lot of traffic, right? So I think that's great advice.
Yeah, that's right. Ultimately, search engines, right? So people need to
Mhm.
understand the intent behind the consumer purchase.
Yeah, yeah. And also, I think sometimes would love to get your thoughts on this, but sometimes I see folks get a little too caught up in just selling on Amazon or creating a listing, and there's a lot of gurus and training sessions on how to optimize your listing. And I think sometimes because it's so easy to launch on Amazon, because it's so easy to set up an e-commerce store, sometimes people forget about building a real business, right? To, like you said, find your first 100 customers, interact with them, treat them as they are, super important to you, because they are, and use their feedback to improve your business. If you have a 4-star rating, figure out how to get it 4.5 or 4.7.
Yeah.
Because if you scale something before it's great, then you're just going to scale something that's not very profitable.
Yeah. I mean, getting rich quick is difficult. So
Yeah.
the reality is you tend to have to forensically understand who the customer is and make sure that they're super happy. And that's the best pathway to more and ultimately scaling. I agree with you. I think there's a lot of people who are saying, oh, wow, this looks easy. I'll launch a business on Amazon. Or, oh, wow, this looks easy. I'll create an e-commerce business on Shopify. I mean, the reality is it's still a business. Yes, it's easier than ever before to start, but it's arguably more competitive than ever before. So as a result of that, whilst you can start seamlessly and simply, growing is actually difficult. And the best founders are those who forensically think through the customer journey, who forensically think through value creation, and understand how their customers perceive their product, and also follow that user journey end to end in such a way that they can create efficiencies. So it's actually, it's more science than it is art, I believe.
Yeah. So true. If you don't understand all the customer acquisition cost, the lifetime value, the how you actually make money in the end, it's great to celebrate, X number of sales or $100,000 in revenues. If you're not making any money in the end, then the business isn't worth anything. So
Yeah, I mean, I
go
would say, just launch is kind of a good sort of mantra to live by. I mean, I know someone right now who has spent over 18 months in R&D for a lipstick brand, and that feels ludicrous.
just like a long time.
You have absolutely no idea whether you can compete in a highly competitive market. And so you just have to get to market.
Yeah. Yeah. So let's fast forward a little bit. Let's say, people have started the business. They're now a couple of years in, like you said, maybe they're doing $1 million in revenue, and start to think about an exit. What are things that you are looking at when they come to you and say they want to sell their business?
So the sort of 3 most important things are financial health, the operational SOPs, so how does the business work, and then price expectation. So financial health is really a function of understanding the metrics that matter to the business. And for the purpose of this discussion, we're talking about e-commerce probably for the most part. So we need to understand, obviously, turnover, but we need to also understand cost of sales. We need to understand the average order value. We also need to understand refund rate. We need to understand, ultimately, gross margin. So those things are really critical that people understand about their business before they try to exit. And the reason being is, one, we need to prepare your business for sale and make sure that it's merchandised well and presented well to a prospective acquirer. But the second thing is, if you don't know the answers to those basic questions, the reality is it will tend to fall over very, very quickly in those discovery calls.
Yeah.
Our job as a platform is to match at scale, and our job as M&A advisors is to ensure that you're well equipped for those discovery calls. The second, the second piece, well, I might even fast forward to the third piece. Then it's about reasonable price expectations. So what a lot of people do, Enrique, is they'll go and think about public market multiples, or they'll go and find some really fast-growing e-commerce business, and probably not so fast-growing anymore, but let's take a Warby Parker, for instance, or Allbirds during its peak, which is obviously not so well. And they will tie their multiples, their price expectation, to the multiples that these public market companies are getting. And that's flawed. Public market companies are very different to subscale M&A. So let's just describe subscale M&A a little bit. So we're talking about businesses which are, for the most part, total turnover of sub $10 million annually. Total turnover of sub $10 million annually. So you're talking about an entirely different scale. And the other thing is the public markets have infinite liquidity. The stock can consistently be traded, and therefore it comes up and down as there's froth in the marketplace. And that's different for pursuing a trade sale for a sub $10 million business. The person is buying it for its historical performance, and it's up to them to leverage long-term opportunity. That's different to public markets. It's different to venture, where they're actually paying for the long-term opportunity versus paying for historical performance. Albeit the market has shifted a lot, but still people tend to tie their multiples to the wrong sector of the ecosystem.
Yeah, that's great.
So reasonable price expectations are really, really important.
Yeah. And how should they think about it then? If the public markets aren't the right, is it a multiple of EBITDA that it comes down to? So
multiple of, so there's lots of ways you can value a business. Obviously, there's a revenue multiple, there's a cash flow basis, there's an EBITDA multiple. The way that we do it at Flippa, which is the most transparent way, is just to look at benchmarks and sort of find a happy medium between the benchmarks and seller expectations, and then let fair market value drive the price. So what does that mean? Well, right now, a really good e-commerce business can still trade for 2 to 3 times revenue, which might end up being something like 5 to 6 times EBITDA, depending on the margins, of course. Now, what the really important thing then is to sort of understand those benchmarks, produce those benchmarks, get alignment on those benchmarks, and then frankly, ask the entrepreneur, how far away from that are their own expectations? Now, let's say that they're reasonably close. So let's say, for argument's sake, we provide a $5 million valuation, which is built around revenue and profit multiple based on historical sales data. If the entrepreneur is reasonably close to that, we will price at their expectations. And we say to them that the critical thing is we're pricing at your expectations. The buyers will now dictate and define fair market value. And so then buyers come in, and the good news is we've got the capability at Flippa to match lots of buyers, so we can drive some competitive tension. And then we get a feedback loop going. Yeah. And that feedback loop ultimately will define fair market value. And then it's about a happy finding a middle ground between buyer and seller. One of the interesting things that does take place, actually, that I should mention, often an entrepreneur is happy to accept terms slightly below their own reasonable expectations if they believe that that buyer is the right buyer for their business. So sometimes emotion will come into play. The second thing is you'll often get the valuation you want so long as you're willing to tie it to some risk. And risk is defined by an earnout or a stability. And so, let's say you've got a $5 million price point, which is therefore $5 million enterprise value. You might actually get your ask, but it might be something like $3 million up front and $2 million deferred. And that $2 million deferred might be a 12 or 24 month earnout based on historical performance. And so that's a good way to sort of think about how you might ultimately end up with what you want, but you're going to have to take some risk along the way.
Interesting. And what does the buyer side look like now? You know, we talked a little bit about the heydays of the aggregators, and how has the buy side changed, and who are, if you were to talk about, you know, your average acquirer, what, or maybe not average, but can you divide them into a few different buckets, and who's buying them?
Yeah, absolutely. So you've got acquisition entrepreneurs, strategics, and institutionals. Acquisition entrepreneurs run the gamut from, you know, low 5 figures up to high 7 figures. And the key thing there is that someone's essentially buying their next job. So it might be that they work in an e-commerce business today and want to run their own. It could be that they already do run a few and they want to combine something else to provide some additional strategic leverage. And maybe they've got a team, but ultimately they're the operator. The second bucket, you know, being strategics, you know, this is becoming a pretty common standard M&A inorganic growth strategy approach, where a bigger business buys a smaller business to give them leverage, to give them incremental revenue. So, for example, there's an online toy retailer, very prominent brand, and that very prominent brand is buying into the baby niche. Now, clearly, they own the toys sector and they do very well there. They're a market leader.
Yep.
But they're going into the baby fashion niche, and that's probably because they believe there's cross-sell opportunity.
Yep.
And so that strategic alignment for them makes sense. They are, you know, turning over in excess of $100 million, and they'll go and buy a business doing $6 to $10 million turnover, and they'll use it as an entry strategy, knowing full well that their hope is to turn that $6 to $10 million annual turnover into double, triple that in short order, having benefited from the operational efficiencies that they can add.
Yeah.
The institutional is a financial buyer. Now, of course, we all thought that the aggregators were taking a strategic approach. Now, ultimately, though, they were financial buyers. They were tended to be run by bankers. They thought they had a bunch of operational capability. That turned out to be less of the case in a lot of examples. And so now they are not buying on strategic multiples. The froth isn't in the market. They're paying more financial buyer multiples. And so the heat has come out of the market. The aggregators are still around. Yes, we'll hear the doomsday stories. Yes, we know that Thrasio, lodged for bankruptcy. Yes, we know that a lot of them there's been a lot of consolidation. But we meet new aggregators every day, and they are still active. It's just that they're not having to compete at the levels they were in the past, and therefore the sales cycles are longer instead of shorter, and the multiples you get are lower instead of higher.
Yeah. That's a great overview. Thank you. And I would assume that the institutional guys, they stay on your platform. They're always there, always looking, versus sort of the entrepreneur buyer is sort of more come and go. Is that right?
Yeah, good point. Most acquisition entrepreneurs are not repeat buyers for obvious reasons. I mean, you and I only have so much money in our bank account, so you can only come back to the well so many times. Whereas an institutional, if that's their entire business model is buying businesses. So in many cases, they're repeat buyers.
Yeah. And then when a business is put out on Flippa, is it marketed to everyone? Everybody can see it. Everybody has access to financials, or is it somehow a more matching process that happened prior to being published?
So we have really an M&A platform, and that M&A platform can be segmented into kind of two broad buckets. Bucket A is self-service, and bucket B is brokered. And self-service is clearly low value, and so we are price agnostic. We're like any other great marketplace in the world. An Airbnb, you can book a room night in a relatively affordable apartment in Orange County, and you can stay in a castle in Scotland. So the reality is we're price agnostic like any other big globally trading marketplace. The managed side of our marketplace is where the money is made, and that's where the matching comes into its own. So we do 425,000 programmatic matches each week, 20 million annually, or 20 plus million annually, and that's all AI driven. So essentially we're looking for intent signals. We then create clusters of buyers, create clusters of entrepreneurs and operators. We then match those clusters up based on their likeness to each other. That's programmatic, that gets smarter all the time, and that's really how you drive the right inquiries into the right advisor, and the advisor represents the business owner. Now that can happen in two buckets as well. Bucket one is it's available on the marketplace, and that's an important bucket because it does drive all the search intent sort of signaling. And so we see in excess of 600,000 buy-side searches on our platform each month, and those are buyers who will tell you exactly what they're looking for. So we need those intent signals to understand where the market's going. But yes, everything is protected under a non-disclosure agreement. And in that particular world of advisory, we have a broker sitting on the end of every inquiry who is triaging the buyers, taking them on the journey, helping sell in the business owner's proposition, getting a sense for, fair market value, getting a sense for whether they like the asset or not. And then, the usual discovery process will happen. But behind the scenes, we're scoring all the buyers, and there's a different level of AI capability there. And behind the scenes, we're also using a bunch of AI to better merchandise assets. So rather than writing an IM, which bankers will slave over, we programmatically create those on the basis of 15 different data integrations. So we connect to Amazon, we connect to Stripe, we connect to Shopify, we connect to QuickBooks Online, Xero, etc. And from all of that data, we can make pretty good assessments as to how the business performs. So all of that work happens. Long story short, we have the public marketplace, and then we have private deal making. And the private deal making operates on the same basis. The AI goes in and finds the buyers, and it pings those buyers and says, we've got a private deal for you.
It's amazing that the volume that you guys are seeing. How many, if you can tell, how many transactions annually do you guys help facilitate?
11,000. So there's 11,000 deals that eventuate on the platform where the entrepreneur receives cash, and the acquirer now owns a new asset or business.
That's incredible. And you guys are still privately owned?
Yes, we're venture backed.
Yeah.
So we're one of the few sort of, I guess, M&A platforms globally that is venture backed, and we're growing really well. 6 years consecutive growth, and clearly we believe that there's lots of great entrepreneurs out there. The asset class is ripe. There will continue to be efforts by Google, Shopify, BigCommerce, Wix, WooCommerce, WordPress, Amazon, etc., to empower and assist business owners to create businesses. And as a function of that, we clearly have a long-term thesis which says there'll be more businesses and more operators than ever before over the next 5 to 10 years. And we also believe that this asset class, which it is an asset class, we believe that there'll be more maturity around it and more awareness for it.
Yeah, that's great. And do you see that in the data? Because I know that during the pandemic, there was an all-time high in new businesses started in the US, and there was a little decline. Has that kind of reemerged and we're setting new records again?
Yeah, so in the US, actually, Small Business Administration reported, I think, don't quote me on this, I think it was 5.2 million net new business starts last year, so 2024, and that was bigger than the pandemic.
That's great news.
There's the entrepreneurial DNA that is rooted in American culture is alive and well.
Yeah. And then, something I talk to my kids about too is that with everything that's happening with AI, I mean, you just talked about how you're replacing bankers almost, or, writing investment memos. Like, what jobs are going to be around 5 years from now? I'm not sure, but I do believe that entrepreneurship is going to still be around, and it's going to be easier to start them.
That's exactly right. And as long as you can create value for both an end user as well as a potential investor or acquirer long term, you can't tell me that there won't be more businesses. They'll just look and feel a bit differently to what they do today.
Exactly. Awesome. Well, we're at time. Blake, I've really enjoyed it. I'm sure our listeners will enjoy it a ton. Thanks for sharing and thanks for taking the time. Before we end, well, two questions. One, anything you want our listeners to know, where to find Flippa, how to reach out, and two, what are you excited about here in 2025, sorry.
Yeah, I mean, thank you so much for the opportunity. I mean, for those that are looking for me, just find me on LinkedIn, ask me any question you've got, and I'll certainly try to assist. Head to flippa.com if you want an indicative valuation for your business. There's a bot there. It takes historical sales data, checks out your inputs, and gives you an indicative valuation. So it's a good place to start. I think that, the thing I'm most excited about is the new categories on Flippa actually that can be beneficial for e-com business owners as well. So our fastest growing categories on Flippa are newsletters and YouTube channels.
Okay.
And so, think about that. If you're an e-commerce business owner, one of the more important things than ever before is having your own brand and community. And so people are starting to think about how they can own media assets to complement their own growth engine. And that's because the cost of a customer on Amazon or Google or Facebook continues to go up and the competition's higher. And so if you can own your own media assets, you tend to be able to hold on to your customers for longer. And I'm loving that theme right now.
Yeah, that is super interesting. Awesome. Any final words of advice for our listeners?
No, thank you. Good luck out there, everyone. Reach out if I can help.
Awesome. Thank you so much, Blake. Best of luck and look forward to staying in touch.